Welcome to the Homeward Bound Podcast by the Mortgage Guys, your ultimate guide to navigating home buying and mortgage lending. Whether you're searching for your first home or settling into your forever home, we're here to make the journey simple, clear, and exciting, helping you secure your dreams one home at a time.
Welcome back to another episode here of the Homeward Bound Podcast. Excited to be back here with you guys today and talking about all things home purchasing. In the last episode, Kyle, you did such a great job of introducing our sponsor. I'm going to turn the time over to you to do that once again, if you don't mind.
You bet. You know, we've got some awesome sponsors for our podcast. This episode is brought to you by Rocky Mountain Furniture, Cedar's hometown favorite for quality, comfort, and style. Located on 200 North. They're local. They've been doing a great job for years. I highly recommend them. I've bought pieces of furniture from them. I know the owners. Fantastic company. Doesn't look like much on the outside, let's be honest. But you go inside and it's pretty amazing. They've been awesome sponsors for our program. But the cool thing is, Dave, is we get to introduce the newest member of our team. It's Myles Anderson. Myles, you want to take a minute and introduce yourself?
Yeah, absolutely. You know, it's been awesome. I just came over to be with these guys here at Premier Mortgage Resources, and working with Kyle and Dave is just the best. It's awesome. We joke around, we talk a lot of golf, a lot of hunting. You can't get better than that, right?
Probably too much of it, but.
Sometimes mortgage.
Yeah, you know, sometimes you got to talk about your job a little bit. But no, I've been in mortgage for a long time. I've been in the banking credit union side of things, and so it's awesome to be over here talking and working in the mortgage world and getting to know more people.
Yeah. So I met Myles. What year was that? 2016, 17?
Yeah, probably 2016-ish.
Coming up on 10 years.
Yeah.
Met you 10 years ago. You're just coming out of college, or you're still in college maybe?
Yeah, last year of college, I think. So.
And, you know, we met because you were applying for a mortgage.
Yep.
Sorry to say that I had to turn you down for that. Somehow, you still thought mortgage was cool, which,
you know. Yeah, it was an interesting time. You know, I didn't still being in college, it was hard to apply anyway, and so we learned a lot through that process, and that's kind of actually what started my interest in mortgage in the first place. So
that's awesome.
Sometimes you get turned down and you still like it.
Exactly. You know, a good mortgage turned down can still maintain friendship afterwards, and obviously you own your own home and successful and doing well, and so I'm glad that we were able to maintain a friendship, which is pretty cool.
Absolutely.
We're actually kind of neighbors now, so
yeah, can't beat it now.
Which is way cool. But yeah, excited to have him.
That speaks volumes if you're still friends and he's coming to work with you even after you did a decline. Sometimes we have to decline people, and I don't think people ever want to see us again when that happens, but hopefully everyone works out this way. No, it's been great having Myles here on the team with us. We our branch here locally, we believe it's quality over quantity. We're not a body shop. We're not looking to put a ton of people in here. We want guys that mesh well, people that mesh well, and people that we all get along, and, you know, like-minded folks. So anyway, welcome aboard. Glad to have you here on the podcast today. Today we're going to talk about something super fun. The most fun part of the mortgage. Once it's in place, it's about the payment, because that's what everyone loves. They love making that payment, right? Mm-hmm. So we're going to talk about a mortgage payment, and it's we brainstorm, obviously, when we think of these episodes. We get together, we talk, we banter, we think about what is it that we need to discuss that would maybe answer some questions for the people that might be listening to this podcast. And one of the things that I've noticed over the years is, you know, people say, what's my payment? Well, it's that's tough, almost like saying what's your interest rate, but what's my payment? Because there's different components to what you actually write that check for each month or do an automatic transfer, because unlike an auto loan, it's not just principal and interest. There's other components to it. And sometimes that can be a little bit shocking, don't you guys think?
Yeah, honestly, that question leads into a conversation. You know, there's a lot of things that go into that, right? We have to turn it back around and say, okay, great. How much you putting down? What's your purchase price? What's your credit score? I mean, there's a number of components to figure out what a payment is, aside from just the other items that go into a payment, which we'll talk about here soon. But it's complicated, and it's not something that you can just rattle off anytime because they're so readily available. I mean, usually it takes a process to figure out what that payment is.
Yeah, and we kind of talked about it this morning, but it's really easy to go online and use an estimation calculator. And how often do we see people say, "Oh yeah, I think my debt to income's right around here," and then we actually start explaining all the parts of a payment and how that comes back, and we're like, "Well, actually, your payment's going to be this," and they get kind of surprised by that. But that's also one of the best parts of the job, in my opinion, is that education piece. And that's one of the fun things about having a podcast is being able to do that, and help hopefully all of the listeners be able to understand and grow knowledge about their payments and mortgage in general. So.
Yeah. And you talk about that, us versus those calculators are online. Let's face it, those calculators, they're developed wherever. Could be New York, could be Kansas, could be California, but we're local, so we're going to be able to help on a local level.
And also, I mean, if you're Googling, what would my current mortgage payment be, those calculators kind of turn into a capture and sales pitch.
Mm-hmm.
Yeah,
I mean, th're not accurate for a reason.
Yeah,
they want you to, that sounds great. I'm going to check out this company that I don't know anything about, but it's online and that payment looks reasonable. Mm-hmm. It's a capture tool. It's an ingenious capture tool, but it's not always accurate.
Absolutely. And I think that's one of the things that, we have to educate these people on, is let them know there's a few different components to it. And first off, the meat and potatoes behind a payment is always going to be the biggest component. We'll call it like the 80-20 rule. 80% of that payment or more, 90% in many cases, is going to be the principal and interest, right? Yeah. And that's basically just simple mathematics, folks. It's what is that loan amount times what is that interest rate, and that basically helps us to come up with a calculation that tells us what is the principal and interest, the P&I of the PITI plus HOA that we're going to start talking about in this particular episode. But what is the P&I? What's the principal and interest of that payment? And that's, as I said, purely mathematics. Now, the things that can change or drive, that up or down one way or another is, I think, first and foremost, more than interest rate, is definitely loan amount, wouldn't you guys say?
Absolutely.
I think that loan amount is the biggest driver of what we're seeing in mortgage payments today versus. Let's talk about this. Back when you declined, Myles, I mean, what would you say the average home price might have been?
Oh man, it's crazy to think about that, because when we were first looking at homes, we didn't want to be above $120,000. That was like our max that we wanted to be below. And that seemed crazy at the time. I think our payment was like $800 a month, but we weren't making very much money. And so obviously, things came to fruition, and we didn't have hardly any other debts. But when all of a sudden it's a $800, $900 a month payment, it kind of made that difference there. But yeah, $120,000 was a good size home back then.
And what would people do for an $800, $900 payment with $120,000?
Well, that's like a truck payment right now.
Yeah, so, your average truck payment.
And so, I mean, you're talking about principal and interest, and obviously the purchase price goes up, your loan amount goes up, unless you have a good down payment, which is fantastic. But some of those big elements of what's my payment is, like I mentioned, what's your down payment? Mm-hmm. If you're offsetting some of that purchase price with some of your own injectable cash, then obviously you're going to experience a less down payment than if you're doing 100% financing, which is available. People get a lot of sticker shock when they see their 100% financing and go like, oh, well, I don't have to put any money down, but I'm sure paying for this.
Yeah. And you do. Makes a huge difference, that down payment. And largely what we see with clients right now is if they're not putting that, if they're not financing 100% or putting 3.5% down, it's people that just maybe sold their home recently.
Yeah.
Right? People that are rolling that equity, just keeping that not rolling, they're rolling it into the next property that they're buying. Yeah. And that helps to keep that mortgage payment down. I saw an interesting thing, and I'll just say this really fast. It was a statistic that I just want to share. Back in like 1990, I'm going back a ways because I bought my first home not too long after that, but that kind of dates me here. But in 1990, the average household income back in those days was $52,000. And I saw this statistic. It really kind of opened my eyes. The average home price that same year was $135,000. This is across the nation, right? $135,000. So it had a 2.6 times factor. You take the household income times 2.6 was what it was. We roll forward to today, where we're sitting at today. Average household income on the median side, shocking to me that it was only at $78,000, but the average home price across America is $429,000. That's 5.5 times as the multiplier. So we went from 2.6 to 5.5. these are things that can go up and down, obviously, but that's where we're at right now. I think that kind of explains some of what you just mentioned when you went to, apply with Kyle and he was so mean and he declined you. So, but obviously the times today are just a little bit different. But anyway, yeah. So interest rate, I don't think has as much of a factor into that payment as the loan amount does.
Yeah.
I think it's the biggest part of it is the loan amount. So interest rates, but let's talk a little bit on interest rates today. Where are we at on that, guys?
Well, what's the most common question we all get every day?
What's the interest rate?
What are interest rates? And that's another conversation. That's like, what's my payment? And with that, we have to turn it around and say, okay, do you know what your credit score is? If you know what your credit score is, what type of home do you want to buy? Because that impacts it. Not only that, what type of loan program are you looking for? Are you looking for a minimum down, or are you going to put 20% down? Because that factors into the mortgage interest rate as well. And so, again, going to these online calculators, they're going to have somewhat of let's call it an attractive interest rate that they're going to put in there just as a default, and it's going to capture your attention. It's not always accurate. And we experience this quite a bit where someone calls and says, what's your interest rate? We turn around and ask them all those questions about the factors that we need. We input those and we come up with an interest rate that isn't exactly what they found online.
Or on a billboard for that.
Or on a billboard.
How many times have we seen that billboard, especially in our state, right?
Yep.
Southern part of the way to the northern part.
All the time.
Yeah. And the thing is as individual as credit scores are, interest rates are as well.
Yeah.
And so it's really difficult. I mean, there are average market rates. We can pull those up and it looks like the average market rate for the standard individual criteria is X. But is that the same for you or is it different? It really just depends. And like you mentioned, Dave, the interest rate is a factor in the payment, but it's not the biggest factor. Especially when we're talking about a rate that's at 6.25 compared to 6.375. I mean, an eighth difference, even 3.5. Did I say 3?
I think you might have. They're
6
in the old days.
I know.
That was a couple years ago, Kyle.
Maybe when you were playing, who knows?
Maybe.
But so 6% ranges, but 0.25%, eighth percent adjustment in your payment. We were talking about that earlier today. You were talking about with the client, the difference in a payment. What did that kind of look like?
Yeah, I mean, honestly, and like we were talking about earlier, it's just that difference really isn't huge, especially if your loan amount's not big, right? If your loan amount's less than $500,000, 0.5% doesn't change the monthly payment very much. And that's, a lot of people think it does, but in reality, it really doesn't. And so until you're getting, 0.75 to a whole percent lower, it's not much of a difference there. And so it's always interesting to show people that and tell them, the difference is, like you had one that you're looking at, it's like $18 difference in the monthly payment, right? And that's one of those things that just probably isn't that big of a deal for most people, right?
It is, and I've got that client, and I've got two of them right now that it's 3-4 times a day right now. We're talking about the rate. What's the rate? What's the rate? Where am I at? And I was like, well, it's pretty volatile right now, so rates are bouncing around a little bit with all that's going on in the economy. And I told them I finally break it down and put it into dollars and cents because that is the best thing. They can get really emotional and stuck on a number in rate, but if you can put it into dollars and cents, I think that starts to make them think a little bit more. And then one of them, for every eighth, it moves $17. The other loans, either loans are in the 200 and something thousand. They have good down payments, but the other one's like $18 a month. And I put it in perspective. I said, maybe that's one less trip to McDonald's, that month. If you're going to have to take that eighth higher, or if you go an eighth lower, you get one extra trip to McDonald's. I mean, you have to kind of put it into relative terms, but
it's pretty sad that a trip to McDonald's is $18 now, but we won't get into that.
Or a trip to Starbucks. I mean,
yeah,
whatever it is,
we'll say that
it won't break your budget, right?
Yeah, exactly. But but that's how the principal and interest part of the payment works, and I think it's safe to say 80 to 90% of that payment is probably almost always principal and interest. So going in addition to that, another component, the T in the PITI.
Yeah.
That's government. Can't get away from them, can we?
Can't hide.
So property taxes. What do you want to say about property taxes, Kyle?
I was having a conversation about property taxes earlier today with one that we're getting close on closing. And they were a little upset that my estimate initially was a little bit different than what the actual property tax was. when they were shopping around, when they weren't sure exactly what type of home or what home or where they were going to be buying. And it was like $18 a month different. So not tragically different, but they were like, whoa, you quoted me this on my payment. Why is this different? My payment's adjusted upward. We locked in interest rate. Like, what happened? I said, well, let's look at it. And I discovered that, hey, your county taxes are now this per month because this is the property you've chosen. We now know that. And this is how much it is. And so every part of your payment that we collect, 1/12 of that is for portions of things like taxes. And so when tax time comes around here in Utah, it's November. Because you've escrowed that portion with your payment every month, we'll take care of the taxes for you. We cut that check. We take care of the county. You're never going to be defaulted on your taxes. You're welcome. I mean, that's honestly probably the best part of your payment. Other than reducing your principal, someone else takes care of a couple of bills for you every year, which is pretty awesome.
Yeah, that's convenient. Then, the thing about property taxes is obviously that's not something that we charge, right? Yeah. It goes to the county, set by the county, determined by the county, and then that's paid to the county, like Kyle just mentioned, once a year if we're impounding that part. But that, Myles, that can go up and down though each year, can it?
Yeah, that's what I was just going to say. I mean, we haven't ever seen it go down lately, but it definitely goes up every year.
Mine went down this last year.
Well, that's lucky.
So
yeah.
I almost took a picture of it. I'm like, look at this. This went down. Like, this is it.
Yeah, that doesn't happen very often. But yeah, I mean, we say one number because that's what we can estimate depending on what county we're in. And then it can go up every year or down, hopefully. But that doesn't happen too often, I don't think.
Yeah, and if the property taxes go up for that coming year, obviously, home buyers need to understand. And we try to tell them that at the closing table. If the property taxes go up, and you have a deficiency, then you're short in your escrow account, if we're covering the taxes for them, they're going to need to make that adjustment to balance things back out. And that's where that property tax number can go up in future years. And then the other item, the I in this whole thing, it's kind of what we talked about in the previous episode on homeowners insurance. And I think we dove really deep into that and talked about that. And if any of you out there have questions on homeowners insurance, really go look under the previous episodes and dive into that. But also, that's something that can fluctuate, right?
Yeah, so that's episode number 3. So check that one out. We actually had a great insurance professional that was part of that. He dove into a lot of factors that we won't simply cover today just because it could take the whole episode. But yeah, 1/12 of your insurance that's due every month is paid through your escrow with your mortgage payment. When your insurance comes due, we cut that check, take care of it. You're welcome. One less bill to pay. And so I love that.
And that one you can shop for. So that one's nice, right? Like they can go and get the cheapest deal if they want to. That's not always the best decision, but it all depends on who you go with and the type of coverage you need and want. And so that one you can shop for and you can kind of get that as cheap as possible if you need to. So that's kind of a benefit when you're shopping for it. So
nice point.
Yep. That one also can adjust annually if the insurance rate goes up. And that's been recently. We talked about in that previous episode. Is, let's face it, home insurance rates are just like auto insurance rates. Everything's been going up in that industry, unfortunately, and that will balance itself out. But yeah, and I think people need to realize once you have a home and you have your mortgage, is like you said, keep up to date on things. Maybe shop it around, see what you can do. But if you have a good agent, just call your agent and say, look, is there anything I can do to save on my rate? And they can tell you if there's something you're missing out on. So anyway, that's homeowners insurance. And now we have the PITI, which you guys have all heard. Everybody out there has heard how that makes up a mortgage payment. But in some cases, we have buyers that don't have that giant down payment, right?
Yeah. So more often than not, isn't that the case that it's very difficult to come up with 20% of these purchase prices in our market right now?
Yeah.
I mean, it happens. People sell their homes or they do have some inheritance or something to the fact where they can come in with the 20% minimum to get away from mortgage insurance. And mortgage insurance, unfortunately, you can't shop for it. We do get quotes, and we always choose the cheapest quote. I mean, we have no incentive otherwise. So we do, kind of shop it. But this is based on how much down payment you're putting. If you're putting down less than 20%, it can help how much your mortgage insurance is. This mortgage insurance doesn't cover your home, right?
It's different than the hazard insurance.
It is.
We talked about in the last episode, right? And that can kind of get confusing, but the mortgage insurance is just covering the mortgage in case of default and things.
Yeah. So if you fail to make your payment, or you default on your home, you know, that little bit over the 80% that you didn't pay to, that 20% or discrepancy between that 20% down, gets covered by that mortgage insurance. So it covers the lender. And so if you have 15% down, your mortgage insurance is going to be less than if you're only putting 5% down.
Okay.
But there's differences with those. And so conventionally, and we're talking about the boring 30-year, 15-year type of loan where it's not a government deal. When you achieve that 20% equity position, that mortgage insurance drops off, which is wonderful. And if you pay a lot of money down, you can request that mortgage insurance to be relinquished and done. Or if you feel like your property is grown in value sufficient, you can petition that there is, an appraisal done. And that's what I did on my home. When I bought my home, the basement wasn't finished. We were in a rising value market too, but finished the basement. And I thought, there's a pretty good chance, because I didn't have 20% to come up with. There's a pretty good chance I could get rid of my mortgage insurance. And so I called my servicer. They sent an appraiser out. And, with that new value, they said, hey, congratulations, we're cutting this $80 off your payment every month. It's made us feel $80 richer every month, which is really wonderful.
That's a big deal. That's a really big deal. We get that asked a lot. People sit there that do these conventional loans and have that mortgage insurance on their payment. They ask, when can that fall off and how can it fall off? We get people that are a little bit overzealous sometimes, don't you think? Where it's like, I think I'm getting such a good deal on this house that in 2 months I want to go ahead and request that come off. And obviously it takes a little bit of time. And you have to have something, like you said, your basement finished and the market value had gone up for a period of months and months, that you can prove it with an appraisal. That's awesome to save that money right off there. But it's a little bit different with the government loans. I think we just touched on with FHA. It's like if someone does an FHA loan at 3.5% down, they're going to have that mortgage insurance there, and it doesn't ever really fall off. It's one of those things that, it more than likely down the road, they're going to need to refinance into a conventional loan to get rid of it. But anyway, mortgage insurance is what it is. But I think you pointed out something really good, Kyle, is that when we're doing, especially for conventional loan, when we know you need mortgage insurance, we have the ability in our loan operating system that we're able to shop every one of the mortgage insurance carriers out there and get them the best rate we can. And it's one of those things that, I'm just like you. Myles is probably exactly the same. I look at every one of those and whatever 10, 12 of them pop up, and it's like lowest one, that's what we're going with.
Yeah.
Because I don't really know if one's going to come through or whatever is needed. I've never heard of anything like that happening. So just go with the lowest.
Yeah.
Yeah, you got to pick the lowest, especially when, a lot of times in those situations, people's debt to income ratio are really close. And so every dollar counts at that time. So yeah, we try to do those and try to make sure it's the cheapest rate possible for you.
Yeah, that's so true right now. Nowadays, it's about getting the qualification ratios to work and just lowering that as much as you can.
It's kind of like title insurance. They all do the same thing. Which one does it cheaper?
Yeah, exactly.
It's might as well to get the cheaper one. There's no reason to ever get the more expensive one. But, Dave, you brought up a great point. Those Govy loans, the FHA, USDA, all those that are tied to government type of situation, that MI sticks around.
Yeah.
USDA, they call it a little something different, but it's the same thing.
Yeah, so you'll never actually see it in your payment because they put it somewhere else, but
it's there. It's got a different name. But, so those go away. So refinancing, getting out of that as quickly as you can is a really great way, especially if you've made more down payment or your values has gone up since your purchase with a government loan. Great way to save some money instantly and perhaps and hopefully capture a better interest rate too.
Yeah, and one thing to add real quick on this mortgage insurance before we jump off this topic is really what does it take to get a better mortgage insurance rate? I think the key to that is obviously better credit. If our borrowers have better credit, then they can basically get a better mortgage insurance rate. And there's a couple other things. It's a funny thing when mortgage insurance companies are quoting us a rate is if there are 2 borrowers versus 1, they get a lower rate on mortgage insurance.
Yeah.
A lower factor. So that's absolutely beneficial as well. So anyway, that's the PITI and the MI. And we're a business all of acronyms, whether it's LTV, DTI, PITI, MI, all this kind of stuff. So there's one other thing that's not part of the payment that I think we need to discuss right now because it really impacts qualifying. Would you guys agree? And that's the HOA fee.
Yeah.
I know HOA is a lot of times a 4-letter word, right? Even though it's 3.
Yeah. 3-letter acronym, 4-letter word.
It frustrates a lot of people, and rightly so in a lot of ways. I know they do some things on your behalf, but typically I hear more people thinking HOA is a headache than it is a benefit. But so if you buy a property, I guess in a community or something like a townhome community, whatever, they have varying HOA fees, right?
They do.
On that's a monthly fee.
Yeah, and a lot of times you forget about that fee, right? And so, but as lenders, we have to take that into consideration, And so if you're moving into a new townhome community, it's going to be $90 a month or more, and that has to be calculated into your debt as if you're having extra debt on your credit, and sometimes that's easy to forget, but it does hinder qualification sometimes.
For sure.
Yeah, it can cause an issue. I mean, I'm just thinking about a couple of experiences where, and we don't have a whole lot of HOA activity here in Cedar City or Southern Utah. It does exist, and most often the HOAs are easy to deal with, and they do a great job. But sometimes our borrowers don't take that in consideration. We give them a pre-qualification or a full approval letter that says, hey, you're pre-qualified up to this. Mm-hmm. They go under contract, and everything's great until we learn there's an HOA. It adds an extra $120 a month. We throw that into calculation and sheepishly go back to the client and say, that is part of your total home expense. And like you said, we count it like a debt or an extra expense for the home, and that can change qualifications. So, for anybody listening, if you're looking at an HOA, please make sure you tell your lender that that's involved so they can run that in, so we don't have to run into the headaches of or heartburn of trying to figure out how to make a deal work when there's an HOA included.
Now in some cases there's, these communities like these townhome developments that have a good master policy, like the HOA, the Homeowners Association, has a master policy over the entire property. And if it's a good policy, it can actually reduce what needs to be for our qualifications for homeowners insurance that they have to carry. Yeah. So in some ways that HOA can kind of save them in another part, and it depends on that master policy. But anyway, that's the HOA. The one thing that's interesting, I think buyers out there, if you're thinking about buying a home, I mean, it seems anymore, especially in our community, when we talk about affordable housing, they're going up all over the place. It's townhomes. Townhome communities are popping up everywhere because it's the best way for a developer to maximize their better bang for their buck, so they can put out homes that have a lower price tag. So that's the affordable model for folks. But in some cases, it may not be the lowest monthly output for a buyer. If they're going to have to pay that HOA fee, and I've seen some that have swimming pools and stuff in communities where that HOA monthly can get up to $140, $150.
They get a pool. I mean,
well, yes, you may as well have it. But there's some, and I've seen others in some of these bigger communities around, in our state and others that can get upwards of $200-$300 a month, and that's not uncommon. But for somebody that's trying to get into that first home and they're really trying to save themselves some money, if they really look at it, you need to kind of evaluate a couple things. We are unique in our community here where we have these twin homes, right? And twin homes are a little bit different because they don't carry HOA fees that they have to pay on a monthly basis. So sometimes you can buy something out of a townhome community that is in a twin home, and your total output, even though you're paying a little bit more for a twin home than a townhome in some cases, because you're saving that HOA fee, your total output could be less.
Yeah, your buying power is a little more.
Yeah, it is. And you don't have to, and you maybe it comes with a bigger garage, more of a driveway, more of a yard. So there's some certain things to consider, and a good agent will kind of explain that to them. But definitely there's just so much that goes into the mortgage payment that people just need to be aware.
Yeah.
So one situation that is interesting is, so Myles and I live in a community that has an HOA, quote unquote.
Yes. But what do they do?
Guess who the HOA president is?
Yeah, it's you. Good job.
Hey,
how you doing, Prez?
Oh, not a good job apparently. But anyway, so we have an HOA. We've never collected dues ever. And I'm not saying that's right, but that may not be the forever situation either. But for the last, I've been in that neighborhood 10 years. No HOA dues. But we have the requirements of an HOA, try to maintain property and all that stuff. And so I haven't run into that besides our neighborhood where there is an HOA should we calculate and count that HOA payment or not, because it's never been charged?
Yeah.
I've helped a few people buy homes in our neighborhood, and I just never add it. But
Well,
I asked the president, he said it's okay.
the president said it. If it's if it's not providing a service or some benefit, then I don't know if that makes any sense. But if there's community expenses, I get it. On townhome communities, they kind of have to, just because they have so much common area, right? And they have to maintain that common area, whether it's mowing it or
green spaces, playgrounds,
resurface parking areas, because it's like that in those townhome communities. But that's not the case in the twin homes. And that's why the twin home could be more bang for your buck. And that's simply just, a home that's two homes that are sandwiched together, although each has their own respective lot. So they have their own parcel. So they are their own property in essence. But anyway, there's so much to consider in this. And honestly, our job is to help find them the lowest way to get that payment as possible. Because that whole payment is really what makes people decide, I want this or I don't want this.
Yep.
One of the things with payment, just right along those lines, and sometimes it's kind of difficult, and these are the conversations that we have, but in the world today, we can often get you qualified for a higher payment than you really want, right? Sometimes you'll think, oh yeah, I'm comfortable with a $1,300 monthly payment, when in reality, that house is going to be $2,500 a month, right? And so having those conversations is huge. And so that's kind of the breakdown of all these things that we've been talking about is how important all of this is to really knowing what you're actually going to pay and then being comfortable with that. Because if it's a huge stretch, it's not always the best thing to do, right? No one wants to be house poor for the rest of their life.
Oh yeah.
And so it is important to kind of know what goes into a payment and really what you're going to be paying for, because it can get a little bit scary if all of a sudden your house payment is, 60% or more of your debt. And so it can get a little bit crazy there.
Yeah. It gets a little tough, but we talked about it. And I think I used that phrase in one of our previous ones is, we can kind of give them enough rope to hang themselves with those payments if it gets a little bit steep and it scares some folks. Yeah. So, but in reality, our job is to make it as affordable as possible, and that's really what we're trying to do. But it takes more than just the mortgage lender, because all we're really providing, besides stellar service, right, guys? Exactly. What we're providing here is an interest rate, and everybody's providing interest rates, but we're kind of all very, very close as far as that goes. We might be lower one day, they might be a little lower, whatever, but it's always within just a small amount. The factors that really drive this overall payment, as we've just discussed, is that how much is that home selling for? We don't control that. What are property taxes? That's definitely out of our control. And then, the homeowner's insurance and the other things. But anyway, so I hope this is helpful. I hope you think it's going to help these folks that are listening.
Yeah. The last thing I would add in trying to reduce your payment is, make sure you get a good agent. They can help negotiate that sales price to be beneficial to you. Even if they can knock off $5,000 to $10,000, I mean, that saves you how much? Interest compared to the original sales price. And so, we've got a lot of really talented, amazing agents in our area. Please reach out to real estate professionals for that, to help them negotiate and help them have them help you get the best deal possible on a purchase. That way it does on their end help you reduce your payment quite a bit too.
Yeah.
So,
all right, guys. Well, thanks a bunch. This was fun. We'll have another episode coming up soon. We're going to talk about it a little bit, but we're going to talk about the economy and mortgage rates a little bit deeper. So look for that in one of our future ones coming up. But thanks again.